everybody, welcome back. The one we've been waiting for, the one that you've been working for, the Iron Condor for the weekly trade. Why am I so excited about this? It's the last one on the list. So we've been working our way through weekly trades. Every single tactic and strategy that I've designed or heard about or read about or learned along the way in all of my educational travels, this is the last one. This is the last weekly. Now, hopefully, through all of this, you've also learned about these different strategies and these different builds, because with a few adjustments, they are the same builds that we're going to use when we get to duration trades. The main difference being, of course, that in a duration trade, we're going to hold on to them longer than a week. So the Iron Condor is two credit spreads put together. When calls came out in the early 70s, they really, there was no puts, just calls. And so at some point, when puts came out about a decade later, not quite, but close, they had the opportunity to build positions above and below the market at the same time using puts. Now remember, they had that option on the call side. They were just selling a debit spread, or selling a credit spread, and then buying a debit spread. And that would give them the same type of trade to a point, but now they had these new things. They had the puts. And in this case, what they could do is they could go below the market with a put spread, and they could sell that. And then they could go above the market with a call spread, and they could sell that. And between those two, all we need is for price to stay inside of it. Now, of course, the wider you go, the better chances you have of being successful, but the less money you're going to make. When you build a spread farther away from price, you're not going to get as much for it. You're also going to stack asymmetrically the risk. Now, big words, right? What the heck does that mean? If an asymmetrical trade is where we risk 1 to make 25 cents, right? Or we risk 5 to make $1. That's an asymmetrical trade. It's what happens when you go onto the web and you look around for credit spread videos and just some random dude on YouTube telling you to go way out of the money and build a 90% win rate trade and telling you how awesome it is because you're going to win 90% of the time. Normally what the guy also fails to mention is that in the wrong environment, it's going to rip right into the 10% of the losing side, and just one loss, when you're risking 5 to make 1, will have wiped out all of the other trades that made you money. And it will also take out some of your own profit, some of your own account. So an asymmetrical trade, building something out of the money when we are in a good, strong, known trend, it's not bad. And in fact, when you look at a standard deviation bell curve statistic, what that thing is telling you is that 70% of the time, if you build it outside of the boundaries of the curve, you're going to win. Because that's typical regular price action. Price should stay inside the bell curve at least 70% of the time. But in an elevated market environment, when price is making drastic swings outside of the boundaries of expected move, you don't want to put on one of those kind of trades. And the reason I'm rambling through all of that is because it's very important you understand that an Iron Condor is a box. You are wrapping a trade around price, and you're saying that you believe that price is not going to get so volatile that it is going to break out of the boundaries of the expected move. In this market environment, and I don't know when you're watching this video, so I'll remind you that in my market environment, we're still dealing with a virus right now. We have elevated volatility right now. You can see the size of the candles on the screen, and since I'm zoomed in, they might not look very extreme. But let me zoom out a little bit. And when I do, you'll realize that the ATR, or the size of the candles right now, is very extreme compared to what we normally deal with. The level of market participants is very extreme. Look how much volume we have here compared to what we typically have. So let's zoom in and look at a regular week. We can see that we have an expected move between 309 and 302, $7. A complete, and we'll round up and call it $8. A complete week where SPY could move plus $4 up or minus $4 down, and that would be an expected move for the week from this Friday to this Friday. Not a lot of volatility. Volume somewhere around 50 million shares a day. Nothing too extreme. And we go from that to the current market environment where we are dealing with a much different market. So now, looking at price at its current location, we've got an expected move of 320 to the upside and 304 to the downside. It's $16. It's twice as much. We've got an $8 move up and we have an $8 move down in the expected move. That's twice as much of a weekly expected move than we saw last week. That's very important to recognize. You would not want to put on this strategy when you see price breaking out of its weekly expected move to the extremes like we have here. Okay, this is very important to recognize and to understand. This is very dangerous conditions. Okay, so the weekly expected move can give you clues about when to put on an Iron Condor. If I look at this kind of market and it's just repeat again and again and again and again of winners, 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 and it's a great environment to put it on. Low volume, low volatility, just a nice, slow, easy grind to the upside. But in the current market with all this volatility, please don't put this trade on. This is not the right time. It is an amazing trade though, so let's start getting into how the trade is built. The trade actually is built by expecting to put a spread to the top side and the bottom side. Of course, the closer you get the spread, the closer you get to being at the money, then the more credit you receive, but the more risk that you take. Remember that price tends to pin to one of these lines way more than is statistically accurate. So you don't want to build your spread right at the line. Give yourself a little bit of room. That way, if you get a week like this one, where it broke out of the top, but it did manage to close fairly close to the line, you don't cut your trade off, right? Give it a little room. Now, let's look at this trade and actually go build it. We've got 320 to the upside, 304 to the downside. The way that we build this, we got two choices. We do want to use Friday's expected move, so we don't build the Iron Condor for a Monday or a Wednesday. We do use Friday. You can right-click at, let's do the 304, and we can sell an Iron Condor. You can see that it pre-built everything for me, and now I would just need to go in and adjust the strikes. The calls are supposed to be at 320. So let's use 319, and we'll use 322. So there's the 319, and here is the 322. That deals with our upside Iron Condor, $3 wide. Let's do 318, right? That way we're $2 away from the strike above it and $2 away from the strike below it, because 320 is the line that we're aiming for on the top side. 3045 is the line that we're aiming for on the bottom side, and we don't have a 50-cent strike. We're going to immediately move lower than the 3055, the 3045, and we'll aim for the 304, which means we need the 302 and the 306. So we change the 4 to a 6, and we change the 3 to a 2. So $4 here, $4 here. This is going to cost us $1.37. We go and analyze the trade. Let's try to reset the risk graph. For some reason I broke it. Still not seeing the trade. Let's try to put it in there again. Analyze trade. No, something's not right here. Let me find out what's going on with my Thinkorswim, guys, and I'll be right back. All right. Well, that was a little odd. I had to shut down and reboot the Thinkorswim, but now everything seems to be working again. And for some reason, although I know I said that we were selling the Iron Condor, it actually had put in a buy order. So flip that around while we were at it. Now we've got the 304 straddled with the 36 and the 32, and we've got the 320 straddled with the 318, 322. That's $4 on each, and that's $2 above, $2 below. It gives us this very big Iron Condor. One thing to recognize right off the bat, and it's the first thing you want to look at, is where are my break-evens? Am I a little too close? Don't get cute with these guys. I know that you want to make money, but we also want to make sure that our break-evens are outside the boundaries of those lines. 320 is the top, and I am not out of it. I need to adjust that. So let's unlock the trade and do a little work on this, and I'll come right. All right, so I still got the $4 wide spread. We still have 2 above and 2 below our lines. And you can see that the 304 is now inside of the boundaries. Okay, now the way I built it, this is what we call a neutral Iron Condor, that we're trying to get as in the middle as possible. And that way it's got an equal chance of running up or down from its current location. You can skew these to one side or the other, especially on the intra-week. So suppose you're looking at the news and the market on Friday and you decide, I'm really not comfortable with the idea of putting that Iron Condor on yet. I think I'll wait for Monday. And then the market opens up on Monday and it runs hard to the downside and it puts us, say, somewhere around that 304 range. There's absolutely no reason at that point to put on the Iron Condor using those same metrics. Okay, the price in that would just not be very good. At that point, you might want to choose different metrics for the Iron Condor. I will put an asterisk in there and say the 320 would still be in play on that Friday, but you could at that point look to put on an Iron Condor for just Monday, or for just Wednesday, or Monday and Wednesday, or for just Friday. So many choices, right? So many choices. Notice how we built the Iron Condor. We have credit spreads. Let's break it all apart and bring it back in. Okay, so I rebuilt the trade, and the reason I wanted to do that is I wanted to be able to turn parts of the Iron Condor off and let you actually get a really good understanding of what's going on in this. So let's turn off one of these credit spreads. This right now is showing a bullish credit spread, and price has a lot of distance before it's wrong. Anything above 304 is going to allow you to keep the credit $51. There is a huge amount of risk down here, $350 to make 50. That's not a good bet. In the current market environment, this is very dangerous. Now, when we get back to regular order, that's a whole different story. Remember what we're trying to accomplish. We believe price is going to pin to one of these lines way more than is statistically possible. And in a regular market environment, we're going to stay inside of those lines a lot. The numbers say at least 70%, but history proves that it's even higher than that, and it normally gets to be around 82 to 85%. That's a great win rate, and we can get pretty tight. All right, but in the current market environment, we don't even want to begin messing with this stuff. It is a very dangerous trade to put on, to believe that we can contain price inside of these boundaries. The elevated implied volatility alone tells you that there is just a lot of danger here. Please don't put on this trade right now. This is not something that we want to do in the current market environment. It's not just for SPY. We believe the same thing is going to apply for anything in the market right now that is elevated, and really just in the market, because The implied volatility is telling us there's a lot of risk out there and everything is just very dangerous. Okay, so no iron condors in anything that's been parabolic, anything that's made major gapping moves, anything that has earnings coming up, and definitely no iron condors in the current market environment. All right, so let's go back in again and look at what we got going on here. You don't always have to use the weekly expected move in these. During the week, you can see a more current or active implied volatility expected move printed right up here in the upper corner. This is the July 10, that's Friday's expiration. Between now and Friday, we're looking at a market that could move 8.25 to the upside and 8.25 to the downside. Now remember, that's the same number we were looking at earlier. But on Monday when the market opens, this is going to come alive and it's going to start moving. If you are looking at the trade and you think, on Friday, we got so much news, so much negativity reaching for us over the weekend, maybe I'll wait until Monday. And then you get in on Monday and the market starts to make this drastic move. It's recovering from the Sunday night gap, and the expected move has expanded from 8.25, say, out to $10. So now we've got less time and a bigger move. That should be concerning. Don't stick to the expected move at that point that is on the chart. Use the expected move that you see in the upper right corner of the screen. Why? Because if it's saying SPY can move farther now with less time, then we want to build our Iron Condor wider. How wide could we go? Now remember, in this trade, we've been building at $4. That's $2 above, $2 below. When we turn the whole thing on, we've got a max profit of $115. We're going to look to close it early, so we wouldn't really look to get the whole 115, but we could because we sold it. But we are looking at $285 in risk. $285 in risk is a lot of risk for something that's only going to make us around, let's call it $50, right? By the time we pay commissions and fees and everything else, let's say we're going to make $50 in this trade. We don't want to risk $285 to make $50. Could we risk less? We could put an alert on price, warning us when we get too close to the edge of the expected move. But the problem is we see SPY break outside of the boundaries and then come back in a lot. So if we start to take heat and we say, oh no, I'm losing money, I got to get out of this trade, cut my losses before it gets bad, and we bail out, lock in a loss, and then price turns around and comes right back in the box, we're going to hate it. It's going to suck. So even when we do start taking those kind of losses, we got to hang on. Let it play out. See if it gets back inside the box. Which means while we're waiting, it could continue to go lower. And then we're looking at that loss somewhere between $91 and $285. That sucks. So we really got to try to figure out what we're going to do with this. I know you might have seen a video out there that says close half the trade down. And I get that. I do. It's one of the reasons that we built this like I did, so we could turn one side off. So suppose, for an example, it's running to the upside and we're getting scared that it's going to break out of the top, and we turn off one side of the trade. So now we keep this one. It says we get to keep our $51, and we turn off the one that's being threatened, and we get our 51 bucks. That sounds good. Looking at it, we're sitting here thinking, oh yeah, that's exactly what I'll do. That solves the problem. But here is the problem. We sold both of these. If we're going to close the top one, that means we had to buy it back. Doesn't sound too bad. Except that if price runs that high and we go to buy it back, we're not going to be able to buy it back for what we sold it for. Oh no. That thing will have made a lot more money, and we're going to have to spend a lot more money to purchase it back. So we might have been able to sell it for $51, but to buy it back, it might cost us $150. That sucks. So when we sell something, we need to buy it back cheaper than we sold it to make a profit, right? If I sold it for 50, I need to buy it back at 25. If I'm buying it back at 75, then I lost the original 50 that I collected, and I had to spend an additional $25 more out of my own account to close the damn thing. So don't get cute with these. If this was a duration trade and we were dealing with managing the trade, one of the choices might be to move the top side. It might be to add contracts. But what we definitely don't want to do is try shutting something down or trying to close it early to minimize our loss, because we'll end up locking in a loss that we could have avoided all along. All right. The main thing about this video is that you understand how to make an Iron Condor and where to set the break-evens. Now remember, 103.04 is the bottom of SPY in this example that we're using, and we need our trade to have the break-evens underneath that 304. Okay, so if SPY stays inside of the expected move from 304 to 320, we see profit somewhere along the way. Maybe you're asking, what about volatility? Sig, you didn't bring that up. Yeah, good point. This green line will start to take the shape of this red line as time goes by. If the trade takes a volatility crush, this red line will also become the green line because we'll see it move up. So volatility crush helps you make your profit sooner. If SPY starts to fall and implied volatility goes up, you will see your profit quicker. Okay, this is the trade that you can let expire if it's in the money. If price stays inside the boundaries here, then you can close the trade at max profit, or let it go all the way into the close. I don't recommend doing that. We want to manage our trades. One of the reasons is because typically you can make more money faster by closing a trade down and opening a new one. You increase your win rate by closing a trade down early and opening up a new one. You also increase your frequency and you keep your money moving. Okay, so we don't want to let these go into expiration typically. Everybody has their own way of doing things. Definitely want to leave the option up to you on that. But now you know how to build an Iron Condor outside the boundaries of the expected move. When I first brought it over here, it wasn't wide enough. We had to make adjustments. And the thing that we were looking to adjust was to keep this break even below the 304 and this break even above the 320. But then we also have to ask, am I willing to risk 285 to make 100 or 285 to make 55? If that number is too big, if it seems like there's too much loss here, you might just reconsider putting on the trade at all. So this is the Iron Condor. It's the last one in the video series. And I know it's been quite a journey to get here, but you should now have a very strong understanding of the multitude of choices that you have during a regular trading week from Friday to Friday. So many possibilities, not just on the SPY, where a lot of these trades excel, but also in the Qs, IWM, DIA, the NDX, the RUT, the STX, and the XST. Those are all index ETFs and ETNs. Guys, I absolutely appreciate your patience through all of these videos. I know it's been a lot. I'm really excited that we got it done with less than 20. And I'm going to continue to work through a new batch of videos, so look forward to those in the coming days.